A popular claim you'll hear about index universal life policies is you'll never lose money. While there is a 0% floor protection with many IULs, that's not exactly what the 0% floor means. Let's take a closer look. Many IUL policies include what's called a 0% floor. That means if the market index has a negative year, the policy won't be credited a negative interest because of market performance. In other words, if the index, like the S&P 500, for example, is down 15%, your policy isn't automatically credited negative 15%. This is one of the features that attracts people to index universal life products. But it's important to understand what the floor protects against and what it doesn't. The floor protects against negative interest crediting tied to market performance. The floor does not eliminate the normal cost associated with owning a life insurance policy. Like any life insurance policy, an IUL has expenses. These are costs associated with providing the death benefit, administering the policy, and maintaining optional riders. Also, loans and withdrawals can affect policy values. For example, let's say a policy has a $20,000 cash value. The market index has a negative year and returns at negative 15%. Because of the floor, the policy is credited 0% interest rather than a negative return, which is great. The floor worked exactly as designed. However, if the policy incurred $400 in charges during the same period, the cash value could still decrease from $20,000 to $19,600. The market loss didn't directly reduce the policy value, the policy charges did. It's also worth noting that policy performance often changes over time. In the early years, a larger portion of the premium may go towards policy costs and insurance expenses. As cash value accumulates, a properly designed policy can become more efficient because the growing cash value may help offset some of those costs. That's one reason many illustrations show slower growth early on and potentially greater accumulation later. The takeaway is simple. The 0% floor protects against negative interest crediting from market performance. It does not eliminate policy costs, loan interest, withdrawals, or other factors that can affect policy values over time. Understanding that distinction is an important part of understanding how an index universal life policy works. For more information, continue exploring our educational videos here on the website. And, of course, if you'd like to discuss your situation with me personally, you're welcome to schedule a brief call. I am always happy to help. I'm John Howe with Lifetime Peace Financial Services. Leave love behind, not financial hardship.